Welcome to Chapter 5, Time Value of Money, Analyzing Annuity Cash Flows, where we'll dig into more realistic cash flow scenarios, what you see in the real world, what you did in Chapter 4, calculating present value and future value. That happens a lot when you're looking at an investment that has no cash flows that occur in between when you buy and sell it, which sometimes an example of that would be raw land. Land wouldn't produce any cash flows if you bought it, so you would buy it in the hopes of selling it for more than you bought it for in the future, and you want to be able to calculate what return you made on that, or be able to calculate what you should pay for it today based on what you think it might sell for in the future. So that's something you might use that calculation from it, those calculations from in Chapter 4, or knowing how much you might have in a savings account and based on how much you put in today at a particular rate. But more realistic things have cash flows that occur more frequently or throughout the time that you would hold the investment, and that's called an annuity. Okay, there's two kind of definitions of annuity that you may have heard of. If you ask someone that was middle-aged or older, like your parents or grandparents that may have invested or bought an annuity contract, those are sold by insurance companies, and those deal with level cash flows throughout the retirement years in a person's lifetime. And they buy an annuity contract with a large lump sum purchase, usually up front. Sometimes they can do monthly payments, but like the example here is you buy the annuity contract for $100,000, and at an 8%, they assume an 8% return on your money and pay you $836 over the rest of your life for 20 years, assuming you live 20 years, and they guarantee it for your lifetime. That's an annuity contract that you may have heard of before, that involves level cash flows throughout a person's retirement years until they die. And that's the common definition. But what we deal with annuity and finance is just what the textbook says: level sets of frequent cash flows, and that's in the second or third page of your textbook. So we're just dealing with calculating either what something's worth today, present value, or what something's worth in the future, future value, if it has cash flows that occur over time. Now, if they're equal or the same, that would be called an annuity. If they're different, it's still we can still calculate the value. It just gets a little more difficult. In practice, when would you use the annuity calculation or cash flow calculation? The answer is all the time. So you would use it either like when you're buying a stock or bond and you wanted to calculate your return, you would use an annuity calculation, solving for the return part of that, the interest part. Whether to buy real estate or not, I use that all the time in looking at real estate transactions. Whether or not to open a business, or whether you should buy a business. You'd use it to determine how much to save for retirement, or do you have enough saved. That's what banks use to calculate mortgage payments or loan payments. So it's used all the time. I would use it. Here's an example for real estate, a local example. This is a restaurant that's currently for sale. It used to be called Narrated. It's for sale for $250,000 basically, and it could be financed over 20 years at a 7% interest rate. And if you did that and put 20% down, the payment would be $1,550 a month. Basically, what you'd come out with taxes and insurance and maintenance costs, you'd have to overcome $2,050 a month in expenses. But the idea with this transaction is, what would my return be, and would it be worth it to invest in this property? And I have to look at all the cash flows and do a time value of money calculation using what you would learn here in this chapter to be able to decide whether I should invest and buy this building or not. And so you would look at your down payment, how much cash flow goes out in the beginning and any repairs you would do, then how much rental income comes in, really the net income, the gross rent minus expenses each year, and the last year, if you were to sell it, how much you would get back if you were to sell the property. And so the things that you'll need to know out of the chapter, and I would recommend going over the chapter in detail as well as the the narrated audio PowerPoints that cover each calculation specifically that we won't get to do in just that extreme level of detail here. Look at the textbook narrated presentations that do a really good job of explaining each of the calculations. In a normal cash flow, what you could know from your last chapter is you could calculate present value. Like in this example, if you deposited $100 today, deposited $125 a year from now, and $150 2 years from now, and all that earned 7% interest, you could use the formulas and the calculator based on what you learned from chapter 4 to calculate a future value. Okay, you'd just take each deposit and compound it for whatever number of years that it's deposited. Like the first $100 is deposited for 3 years, so you'd figure out the future value of that $100 at 7% interest for three years. The second amount, the $125, is in there for 2 years, so you would look at the future value for 2 years and add all those up and calculate their value. But it's a whole lot easier if the cash flow amounts are the same, and that's when we use what's called an annuity calculation. And there's a formula, and then there's a way to do it in your calculator. If you can do what you did in your calculator last chapter with the last chapter, you can do these. It's just inputting some different information into the calculator. For here, let's suppose we had $100 deposits over 5 years of the interest rate %. So you've already inputted your number of periods, interest rate per year, present value and future value, those type things. This, where instead of having just one present value amount, we're putting $100 in as a payment. Now remember, if it's something we're saving or investing, it's a negative number. If it's money we get back, it's a positive number. So that's why here as a payment it shows as a negative number, because we're saving it and we get back a positive number in the future. We get our money back, and that's that 586 number. Okay, but if you put those in the calculator and go through those step by step, the textbook explanations for each of these calculations in both your book and the narrated PowerPoints, and that'll help a lot. But the concept is we're adding payments and calculating what a future value would be. So if you were to put these things into your calculator, like here, changing it to a $50 deposit over 20 years at 6%, and input these first 4 values into your calculator. Now you make sure you hit the clear time value of money. If you're using the Texas Instruments BA2+, make sure you clear things out. And if you're using the TI-83+, make sure this is just the compounding frequency is annually. It's just once a year at this point, so sure you have just one in for that. Okay, and there are a few more examples. I'll post this full presentation on the website as well online, so you can see the practice those. And then next is just calculating a present value of multiple cash flows. So we're calculating a present value versus a future value. And remember, this is called discounting. You learned that from chapter 4. But calculating a present value. So it's saying if it produces those cash flows in the future, what would it be worth today? And that's the idea of a present value. Like for this example, 399.27 produced $100 payments for 5 years in the future at 8% interest. So it really helps you decide how much should I pay for something today if it produces those cash flows that I think it will. It means if something produces $100 a month cash flow, $100 a year cash flow at 8% interest over 5 years, I should pay basically $399 for it. Okay, and the perpetuity is just a different way of saying it. If what we've done before, we're assuming the cash flows end at some point. With a perpetuity, it does not end. We're assuming they continue for life. But these are easy to calculate a value for, so it's just saying what's the present value of something that would create cash flows for life. So it's just saying, like, if I had a payment of $50 and the rate was 8%, what amount would I have to have today to produce that $50 for life. So the example here is that if it pays $100 per year forever, and the rate is 10%, it's just saying $1,000 would produce that $100 a year. Another way to say it is, if I invest $1,000 and it were to pay 10% forever, it produces $100, or 1,000 times 10, $100 a year in interest or income each year. And that's that's about all you need to know about that, just how to calculate it. And the last thing on annuities is, one of the last things is calculating an ordinary annuity versus annuity due. What you've been working with so far at the end is assuming that the payment occurs at the end of each period. That's an ordinary annuity. However, a lot of calculations will have to start a payment at the beginning of the period, and those are called annuities due. Okay, it just means, say at the beginning of the month of the year is when you start saving or when you start taking the withdrawal. Okay, like for example, if I were going to start a retirement savings plan, I might start right now at the beginning of the month instead of to the end of the month to start saving. And it walks you through several examples, and we just where you put in the number of months. The difference would be in the calculators is the number of months. So we need to multiply the number of years times 12 and get months instead of years. And we need to put in a compounding frequency of 12. And we change that in the calculator. And the best way to do that is to look at the textbook narration on that, or look in the textbook or the narrated audio file, and it will explain that in detail how to change that in your calculator. So there's a setting in the Texas Instruments BA2 Plus to change from 1 period per year to 12. It's really easy in the TI-83 Plus because you have that right on the screen where you input variables. An effective annual interest rate, and you can look at that. There's not a lot of focus on that this chapter, but look at how to do that, and don't worry so much about the calculation part. But you also want to be able to calculate to find different parts of that formula, like to solve for rate, or to solve for payment, solve for time or periods. And this example walks you how to do that. You'll see that again in the book, the audio narration. But if you have questions on that, feel free to let me know too. Just in summary, is concepts, how to understand what annuities do, or how different changing things affect future value, present value. You want to know when calculating future value, of course, larger payments would make an impact on it. The rate has a huge impact on increasing future value, and so does the periods. The longer the periods you have. Also, the more frequently you compound it makes that value higher. But you got to get straight in your mind of what affects present value. Okay, the lower the interest rate would cause a higher present value, as well as a shorter period and less compounding period. So it's just the opposite of future value. Okay, so it means if it takes less money, for example, or it takes more money if we're increasing the present value. For example, if we just think of it this way, if we have less time to invest, we need more money up front in order to get the same value in the future, right? So a shorter period, if we have less time, it means we need to have more money right now.